Right now, there are approximately 18 million veterans living in the United States. Of those, about 22 million, including active duty service members, are eligible for VA home loan benefits. And yet, only about 1.4 million VA loans are originated each year. That means roughly 60% of eligible veterans and service members either don't know about the VA loan, don't understand it, or are choosing not to use it. And that's costing them tens of thousands of dollars. We're going to fix that right now. For the next few minutes, we're diving deep into the VA home loan, one of the most powerful, most valuable, and most underutilized benefits available to those who serve. We're talking zero down payment, no private mortgage insurance, competitive interest rates, and loan limits that go up to $806,500 in most areas and over $1.2 million in expensive markets. This benefit alone can save you $50,000 or more compared to a conventional mortgage. So, whether you're a veteran, active duty, thinking about buying your first home, or a financial professional working with military clients, this is information that you need to know. So let's get into it. The VA Home Loan Program was created by the Service Members Readjustment Act of 1944, better known as the GI Bill. After World War II, millions of service members were returning home, and the government recognized that helping them buy homes would be good for them, good for the economy, good for the country. So, Congress created a program where the Department of Veterans Affairs would guarantee a portion of home loans made by private lenders to eligible veterans and service members. Here's how it works. The VA itself doesn't lend the money. You're not getting a loan directly from the government. Instead, you go to a private lender, a bank, a credit union, a mortgage company, and that lender makes you a loan. But the VA guarantees part of that loan. Specifically, the VA promises that if you default and the lender loses money, the VA will cover up to 25% of the loan amount. That guarantee is a big deal for lenders. It reduces their risk, and because the risk is lower, they can offer you better terms. No down payment required, no private mortgage insurance, and typically lower interest rates than you'd get with a conventional loan. The VA loan program is a win for everyone. You get better loan terms, the lender gets a government guarantee, and the VA helps veterans achieve home ownership. Now, let's talk about who qualifies. The VA home loan benefit is available to several groups of people. First, veterans. If you served on active duty and were discharged under conditions other than dishonorable, you may qualify. The specific service requirements depend on when you serve. If you served during wartime, World War II, Korea, Vietnam, Gulf War, or the post 9/11 era, you generally need 90 consecutive days of active service. If you served during peacetime, you typically need 181 days of continuous active duty. If you were discharged earlier due to a service-connected disability, those minimums don't apply. You can still qualify. Second, active duty service members. If you're currently serving on active duty in the Army, Navy, Air Force, Marines, Space Force, or Coast Guard, and you've served at least 90 continuous days, you're eligible to use your VA loan benefit right now. You don't have to wait until you separate or retire. Third, National Guard and Reserve members. If you've served at least 6 years in the selected Reserve or National Guard and you were discharged honorably, you qualify. If you're still serving in the Guard or Reserve, you're eligible after 6 years of service. Fourth, surviving spouses. If your spouse died in service or from a service-connected disability and you haven't remarried, or if your spouse is missing in action or a prisoner of war, you may be eligible for VA loan benefits. This is a huge benefit for military families who've made the ultimate sacrifice. Those are the basic eligibility categories. To actually use the benefit, you need to obtain a Certificate of Eligibility or COE from the VA. Your COE proves to lenders that you're eligible and tells them how much entitlement you have. We'll talk more about entitlement in a minute, but first, let's talk about the benefits. The number one benefit of a VA loan, and the one that gets the most attention, is the zero down payment required. With a VA loan, you can finance 100% of the purchase price of a home. If you're buying a $300,000 house, you can borrow $300,000, no money down. Let me put that into perspective. With a conventional loan, most lenders require at least 5% down, and many prefer 20%. On a $300,000 house, 5% down is $15,000. 20% down is $60,000. That's a huge amount of money to save up, especially for young service members or veterans who are just starting their civilian careers. With a VA loan, you don't need any of that. You can buy a house with zero money down. Now, does that mean you shouldn't put money down if you have it? Not necessarily. You can still make a down payment if you want to. Putting down 5% or 10% will lower your VA funding fee, which we'll talk about later. But the point is, you don't have to. If you don't have a big pile of savings sitting around, you can still buy a house with a VA loan. According to a 2024 study by the National Association of Realtors, 74% of first-time VA loan users put zero down on their home purchase. Compare that to conventional first-time home buyers who had a median down payment of 12%. When you factor in closing costs, a conventional buyer would need about $51,600 up front to buy a typical $430,000 home. Money that a VA loan buyer doesn't need. The study found that at a 15% savings rate on an income of $78,700 per year, it would take 4.4 years to save that $51,600. For many veterans, that's 4.4 years of continued renting when they could have been building equity in a home with a VA loan. The second massive benefit is no private mortgage insurance. PMI is insurance that protects the lender if you default on your loan. With conventional loans, if you put down less than 20%, you're required to pay PMI, typically between $100 and $300 per month, depending on your loan amount and credit score. Over the life of a 30-year mortgage, that can add up to $36,000 to $108,000 in additional costs. VA loans don't require PMI, ever, even with zero down. That's because the VA guarantee acts as the lender's protection. So you save that $100 to $300 per month every month for as long as you have the loan. That's thousands of dollars per year staying in your pocket instead of going to an insurance company. Let me give you a real example. Meet Sarah. She's a Navy veteran who bought a $350,000 home with a VA loan. Zero down, no PMI. Her monthly principal and interest payment is about $2,200 at 6.5% interest rate. If she had used a conventional loan with 5% down, she would have had to pay $17,500 up front, and she'd be paying about $175 per month in PMI. That's $2,100 per year. Over 30 years, that's $63,000. Sarah didn't have $17,500 saved up, and she's saving $175 per month by using her VA loan benefit. That's the power of the VA loan. The third benefit, competitive interest rates. VA loan rates are typically lower than conventional mortgage rates. Why? Because the VA guarantee reduces the lender's risk, so they can afford to charge less interest. As of late 2024 and early 2025, VA loan rates have been running about 25 basis points to 50 basis points lower than conventional rates. That might not sound like much, but over 30 years on a $300,000 loan, a 0.5% difference in interest rate is about $30,000 in savings. That's real money. The fourth benefit, flexible credit requirements. The VA itself doesn't set a minimum credit score requirement for VA loans. However, most lenders want to see a credit score of at least 580 to 620. Some will go as low as 550. Compare that to conventional loans, which typically require a 620 minimum and often prefer 700 or higher. FHA loans require 580 with 3.5% down or 500 with 10% down. But with a VA loan, even if your credit isn't perfect, you have a path to home ownership. The fifth benefit, assumable loans. VA loans are assumable, which means if you sell your house, the buyer can take over your existing VA loan with its existing interest rate, assuming they qualify. This is a huge selling point if interest rates have gone up since you bought the house. Let's say you bought your house in 2021 when VA rates were 2.5%, and now rates are 7%. A buyer who can assume your 2.5% loan is getting an incredible deal, which makes your house more attractive and potentially worth more. The sixth benefit, no prepayment penalty. If you want to pay off your VA loan early, you can, and the lender can't charge you a penalty. That's required by law. So if you get a big windfall, like an inheritance, a bonus, or lottery winnings, you can throw that money at your mortgage and pay it off faster without any penalty. Now, let's talk about VA loan limits and entitlement, because this is where it gets a little complicated, but it's really important. Prior to 2020, the VA capped the amount they would guarantee on a loan, which effectively limited how much you could borrow with zero down. But in 2020, that changed. Now, if you have full entitlement, there is no cap on the loan amount. You can buy a house for $500,000, $800,000, $1.2 million, whatever the lender is willing to loan you based on your income and credit. And you can still do it with zero down and the VA guarantee. So what is entitlement? Entitlement is the amount the VA will guarantee on your behalf. The VA guarantees up to 25% of the loan amount. If you have full entitlement, the VA will guarantee 25% of whatever the loan amount is, no matter how big it is. That means lenders can confidently give you a loan for the full purchase price with no down payment because they know if you default, the VA will cover 25% of it. You have full entitlement if you meet one of the following conditions. You've never used your VA loan benefit before. You previously used your VA loan, but you paid it off in full and sold the property. In that case, your entitlement is restored. Or you used your VA loan benefit but had a foreclosure or short sale and you repaid the VA in full for any losses they incurred. If you have full entitlement, loan limits don't apply to you. You can borrow as much as your lender is willing to give you based on your finances. But what if you don't have full entitlement? What if you currently have an existing VA loan on a property you still own, or you had a VA loan that went into foreclosure and you haven't repaid the VA? In that case, you have partial entitlement or remaining entitlement, and that's where the loan limits come in. For 2025, the standard conforming loan limit, which the VA uses as a reference point, is $806,500 for most counties in the United States. In high-cost areas, it's higher. For example, in expensive markets like San Francisco, Los Angeles, New York City, Washington, D.C., and other high-cost counties, the loan limit can go up to $1,209,750 or higher. If you have partial entitlement, the amount you can borrow with zero down is calculated based on 25% of the conforming loan limit in your county minus the entitlement you've already used. It's a formula and it can get complicated, but here's the simple version. If you have partial entitlement and you want to buy a house above $144,000, lenders will often limit you to borrowing up to 4 times the amount in your remaining entitlement without a down payment. For example, let's say you have $100,000 of remaining entitlement. 4 times that is $400,000. So you could get a VA loan for up to $400,000 with no down payment. If you want to buy a house for $500,000, you'd need to put down $100,000 to cover the difference. Now, most first-time VA loan users have full entitlement, so this isn't an issue. But if you're a veteran who already owns a house with a VA loan and you want to buy a second property with another VA loan, or if you had a past VA loan that went into default, you need to understand remaining entitlement. The good news is you can restore your entitlement. If you've paid off your VA loan and sold the property, your entitlement is automatically restored. You just need to request it through the VA. If you refinanced your VA loan into a conventional loan and no longer have a VA loan, you can restore your entitlement. Even if you've lost entitlement due to a foreclosure or short sale, you can restore it by repaying the VA for any losses. Now, let's talk about the VA funding fee. This is the one cost that trips people up, and I want to make sure you'll understand it. The VA funding fee is a one-time fee paid to the Department of Veterans Affairs to help fund the VA loan program. Because the VA loan program doesn't require down payments or PMI, the VA needs a way to offset the costs and risks of the program. That's what the funding fee does. For most veterans buying a home with a VA loan for the first time, the funding fee is 2.15% of the loan amount. If you're buying a $300,000 house, that's $6,450. If you've used your VA loan benefit before and you're using it again, the fee goes up to 3.3%, which would be $9,900 on a $300,000 loan. Now, here's the thing. You can either pay that fee in cash at closing, or you can roll it into your loan amount. Most people, about 99%, choose to roll it into the loan. So instead of borrowing $300,000, you borrow $306,450 and you pay it off over the life of the loan. Yes, you'll pay interest on it, but it means you don't need that cash up front. You can also reduce the funding fee by making a down payment. If you put down 5% to 9%, the fee drops to 1.5% for first-time users. If you put down 10% or more, it drops to 1.25%. So if you have some money saved, but not the full 20% down, putting down 10% can save you money on the funding fee. The funding fee is different for different types of loans. For a VA interest rate reduction refinance loan called an IRRRL or a VA streamlined refinance, the funding fee is only 0.5%, which is much lower. For a VA cash out refinance, it's 2.15% for first-time users and 3.3% for subsequent users. For National Guard and Reserve members, the fees are slightly higher. 2.15% becomes 2.4%, for example, unless you're activated for at least 90 days, in which case you pay the regular rate. Now, here's the best part: exemptions. Certain veterans and service members are completely exempt from paying the VA funding fee. If you receive VA disability compensation for a service-connected disability, you don't pay the funding fee, period. Even if your disability rating is only 10%, you're exempt. If you're eligible for disability compensation, but you're receiving military retirement pay instead, you're still exempt. If you're an active duty service member who's been awarded a Purple Heart, you're exempt. If you're a surviving spouse receiving dependency and indemnity compensation, you're exempt. This exemption is huge. On a $350,000 loan, the funding fee would be $7,525 for a first-time user. If you're exempt, you save that entire amount. And since about 40% of veterans have some level of service-connected disability rating, a significant portion of VA loan users don't pay the funding fee at all. Your certificate of eligibility will show whether you're exempt. If you have a pending disability claim that gets approved after you close on your loan and the effective date of your disability is before your closing date, you can request a refund of the funding fee you paid. I've seen veterans get refunds of $5,000, $7,000, and even $10,000 because their disability claim was approved retroactively. Let me give you a cost comparison so you can see the real savings. Let's say you're buying a $400,000 house. Conventional loan scenario, 5% down is $20,000. You borrow $380,000. At 7% interest, your monthly principal and interest payment is about $2,527 a month. You also pay PMI of about $250 per month until you reach 20% equity. Your total monthly payment is $2,777. Over the first 10 years, you'll pay about $30,000 in PMI. FHA loan scenario, 3.5% down is $14,000. You borrow $386,000. You pay an upfront mortgage insurance premium of 1.75%, which is $6,755 rolled into the loan, bringing your loan amount to $392,755. At 6.5% interest, your monthly principal and interest payment is about $2,482. You also pay annual mortgage insurance of about $245 per month, and so your total monthly payment is $2,727. The mortgage insurance never goes away unless you refinance into a different loan. VA loan scenario, 0 down. You borrow $400,000. The VA funding fee is 2.15%, which is $8,600 rolled into the loan, bringing your loan amount to $408,600. At 6.5% interest, a lower rate because it's a VA loan, your monthly principal and interest payment is about $2,582. No PMI, your total monthly payment is $2,582. If you're a disabled veteran, you don't pay the funding fee at all, so your loan amount stays at $400,000 and your monthly payment is about $2,527. Let's compare the first 10 years. Conventional, $20,000 down plus $30,000 in PMI equals $50,000 in upfront and additional costs. FHA, $14,000 down plus $6,755 upfront MIP plus $29,400 in annual MIP equals about $50,155. VA loan, 0 down, $8,600 funding fee, 0 PMI equals $8,600 total. Even with the funding fee, the VA loan saves you over $40,000 in the first 10 years compared to conventional or FHA. And if you're exempt from the funding fee, you save the entire $50,000. That's why VA loans are so powerful. Now, let's talk about the different types of VA loans. The most common is the VA purchase loan, which is what we've been talking about, using your VA benefit to buy a home. But there are other types. The VA interest rate reduction refinance loan, or IRRRL, is a streamlined refinance. If you already have a VA loan and interest rates have dropped, you can refinance into a new VA loan with less paperwork and a lower funding fee, just 0.5%. The goal is to lower your interest rate and monthly payment. You don't need a new appraisal in most cases, and you don't need to verify income or credit in the same way. The VA cash out refinance lets you tap into your home's equity. Let's say you bought a house with a VA loan for $300,000 and now it's worth $400,000. You can refinance into a new VA loan for, say, $350,000, pay off your existing $250,000 mortgage, and take the remaining $100,000 as cash. You can use that cash for anything: pay off debt, home improvements, college tuition, whatever you want. The funding fee for a cash-out refinance is higher, 2.15% for first-time users, but you're still getting cash out of your home. There's also the VA construction loan, which lets you finance the construction of a new home. You can buy the land and build the house, all with one VA loan and zero down. This is less common, but available. And there's the Native American Direct Loan, or NADL, which is a direct loan from the VA, not from a private lender, for eligible Native American veterans to buy, build, or improve a home on federal trust land. Now, let's bust some common myths about VA loans, because there's a lot of misinformation out there. Myth number 1, sellers don't like VA loans because they take forever to close. False. VA loans close in about the same time frame as conventional loans, typically 30 to 45 days. Yes, there's a VA appraisal required, but that's not significantly slower than conventional appraisals. Some sellers and real estate agents are wary of VA loans because of outdated information, but the reality is VA loans are fast and reliable. Myth number 2, you can only use your VA loan benefit once. False. You can use your VA loan benefit multiple times over your lifetime. As long as you pay off the previous loan and sell the property, or you have enough remaining entitlement, you can keep using the benefit. Some veterans have used their VA loan benefit 5, 6, 7 times over their lives. Myth number 3, you can't buy a fixer-upper with a VA loan. Mostly false. The VA does have some minimum property requirements. The house has to be safe, sanitary, and structurally sound. So you can't buy a condemned property or something that's falling apart. But you can buy a house that needs cosmetic work or minor repairs. And if you want to buy a fixer-upper and renovate it, you can use a VA renovation loan. Myth number 4, VA loans are only for first-time home buyers. False. You can use a VA loan whether it's your first home or your fifth. There's no requirement that you be a first-time home buyer. Myth number 5, you can't use a VA loan to buy a condo or multifamily property. False. You can use a VA loan to buy a condo as long as the condo complex is on the VA's approved list, and you can use a VA loan to buy a multifamily property with up to 4 units as long as you live in one of the units as your primary residence. So you can buy a duplex, triplex, or fourplex, live in one unit, and rent out the others. It's a great way to build wealth. All right, let's talk about how to actually get your certificate of eligibility and start the process. There are 3 ways to get your COE. First, you can apply online through the VA's e-benefits portal. It takes about 10 minutes, and if you have a straightforward case, you can get your COE instantly. Second, your lender can pull your COE for you through the VA system. Most VA lenders do this as part of the application process. Third, you can mail in VA Form 26-1880 along with your DD-214 or other proof of service. This takes longer, a few weeks, but it works. Once you have your COE, shop around for lenders. Not all lenders offer VA loans, and among those that do, rates and fees can vary. Talk to at least 3 lenders. Ask about their interest rates, their lender fees, and their experience with VA loans. Look for a VA-approved lender who understands the program and can guide you through it. Get pre-approved. This means the lender reviews your finances, your income, credit, debts, and gives you a letter saying how much they're willing to lend you. This makes you a stronger buyer when you're house hunting. Find a real estate agent who understands VA loans. Some agents are hesitant to work with VA buyers because of misconceptions, but plenty of agents love working with veterans and understand the process. Make an offer, get it accepted, and go through the closing process. The VA will require an appraisal to make sure the house meets minimum property requirements and is worth at least the purchase price. Assuming everything checks out, you close on the house, the VA guarantee goes into effect, and you're a homeowner. Here's my advice. If you're eligible for a VA loan, use it. Even if you have money saved for a down payment, even if your credit is great and you qualify for a conventional loan, the VA loan is almost always going to be a better deal. Just avoiding PMI alone is worth it. The lower interest rate is worth it. The flexibility is worth it. And if you're a disabled veteran exempt from the funding fee, there's literally no downside. You're getting a zero down, no PMI, low rate mortgage with zero upfront costs beyond normal closing costs. That's unbeatable. If you've used your VA benefit before and you think you're out of entitlement, check again. You might have more entitlement available than you think, especially with the 2020 changes that eliminated loan limits for those with full entitlement. If you're a surviving spouse, don't overlook this benefit. It's there for you, and it can make a huge difference in your ability to buy a home and build financial stability. And if you're a financial advisor or real estate professional working with veterans, please learn this benefit inside and out. Too many veterans are being steered towards FHA or conventional loans because their advisor doesn't fully understand the VA loan. That's costing veterans tens of thousands of dollars. Be the person who helps them maximize their benefits. The VA home loan is one of the best benefits available to those who've served. It's helped millions of veterans and service members achieve the dream of home ownership. Don't let it go to waste. Let's build a community where veterans know their benefits and use them to build wealth and security. Thanks for watching, and remember, you earned this benefit through your service, so use it.